For those of you who just jumped in, welcome to the presentation today. We're going to give this just about 1 or 2 more minutes, and we've got quite a few folks who are registered for the event. We're kind of monitoring that number. So as we get close to that number, or maybe no later than 12:03, we'll get going here. So that you're aware, and for disclosure reasons, today's presentation is being recorded. We'll send this out to you if you're on the registration list, so that you can go back and share this with your team, perhaps, if it is relevant. And we'll also be recording at the end of the presentation today. We're going to be recording a shortened version of today's presentation, which might be something that's more digestible for your team if you want to use that in training. With that in mind, I'll introduce my team. We're at 12:02, so let's go ahead and get started. My name is Tim DeSetti. Joining me today is Tammy Tetzloff, Director of Operations on our 401k, 403b retirement plan team, as well as proud father of my son, Zach DeSetti, another advisor on our team. Most of you know most of us. Today is a pretty technical presentation. The Secure Act 1.0 was passed earlier in the decade. Secure 2.0 was passed in December of 2022, and really Secure Act 2.0 was a very, very broad piece of legislation. It affected over 90 different pieces of 401k legislation, 403b retirement plan legislation, and it's all to be phased in over a period of years. And so some of this water has gone under the bridge, so to speak. We're going to quickly recap what's already been implemented, and then we're going to go into what's currently being implemented this year, as well as in upcoming years. From an administrative standpoint today, what I'd like to encourage you to do is the chat box is not working, and it works, but it's not applicable today. What we'd like you to do is, if you have a question throughout the presentation, at the top of your screen you should see a little hand that says raise. Raise your hand if you have a question or a comment about any of the slides that we're presenting. We'll monitor that, and we'll turn off your mute so that you can ask a question at that time. Zach, Tammy, any other housekeeping things that I've forgotten before we cruise on through here?
No, I think you covered everything.
Good. So let's jump right in and talk about what's currently being implemented within the 401k plans, 403bs. In terms of next slide. Great. These are the conversations that we have been having as advisors to all the retirement plans that we work with. The majority of record-keeping providers, and now when I say majority, not all of the record-keeping providers are currently able to offer you all of these provisions, but the majority have these options available to you right now. And so briefly, even if you did add them, we want to kind of recap the importance of these new provisions. Essentially, the federal government has identified that there's a lot of, especially in times of high inflation like we have right now, employees, moreover, are demanding access to different sources of money. Borrowing money is incredibly expensive right now. We've had a couple of requests just this week for participants who've been reaching out about this first provision, qualified birth and adoption. The federal government has paved the way for an employee, if your plan chooses to allow them, whether they're going through a very expensive adoption process, perhaps they're going through a very expensive fertility process, or it's just expensive to have a baby in today's world. So they've approved this position, what we call, it's a terrible name, but we call it's a QBAD provision, a qualifying birth and adoption, to let them take $5,000 out of the plan. The second provision here, and again, each one of these provisions can be adopted or not adopted voluntarily. They're not a package. You don't have to do them all, but you could individually address this within your own company or your own organization's retirement plan. What I call the FEMA provision is the second provision. You have to officially be in a FEMA designated disaster area. And if you are in that area for the next 6 months, you can take a distribution up to $22,000 penalty-free to be able to deal with the financial ramifications of that disaster. Unfortunately, terminal illness happens. If someone has been certified by a physician that their life is in jeopardy and that they likely got 84 months or less to live, there is the ability to access your 401k. I believe it's up to 50% of the account balance, and there is a dollar cap. One of my teammates can jump in if they know the dollar amount on that. But most of our plans are adopting this provision because they understand the hardship that something like this can create. Domestic abuse, again, we'd like to think that this would never happen or should never happen, but in the event it does happen, it can be very financially devastating to the victim of domestic abuse. And so the federal government has paved the way to allow $10,000 withdrawal or up to 50% of the employee's vested balance to deal with, home relocation. Perhaps they need to purchase a new car, something of that nature. That's from our experience, the kind of financial ramifications we've seen happen in these situations. And then finally, I know Zach, we've got a slide later where Zach's going to talk a little bit more detail about the different emergency distribution provisions that have been added. There are two primary emergency distribution provisions. One is available pretty readily right now on almost all platforms, and that is the ability for an employee to take $1,000 one time in a 3-year period. If they don't repay it, it's limited to only once every 3 years. But that is a penalty-free, tax-free distribution from any source within their vested balance inside of the retirement plan. And so again, we're not saying that these are right for every organization, but most organizations have addressed this. And if you have not, or if you have questions, be sure to circle back to us, and we can help you understand whether those provisions are right for your firm. So that's what's available in the past. And again, most people have addressed that within their plan. Here's what we're kind of tackling right now in terms of provisions that are supposedly, and again, I say supposedly because you can see in blue print on the screen, this is entirely subject to whether your record keeper, again, this could be Fidelity, Vanguard, Empower, K-Trade, Alaris, all, there are dozens and dozens of record keepers. They are at all different levels of preparedness for these provisions. The first of which is dealing with the Roth provision. This is a technical correction in reality. When they wrote the original Secure 2.0 Act, they forgot to include the fact that Roth account balances were not subject to required minimum distributions. That's what that RMD term is, required minimum distributions. So that's a technical correction. One of the second provision is one that almost all companies are embracing, and that is the ability to keep their plan cleaned up from terminated participants. So whether an employee retires or leaves employment for any reason, the old rule is that you can distribute those employees throughout a process if they have $5,000 or less. That's being increased to $7,000. So again, most plan providers are embracing that and have adopted that so that they can keep those small account balances out of the plan. I would, Zach and Tammy and I just got back from our national conference of plan advisors. And one of the things that there was a fair amount of time spent on that I was unaware of is that there's been a national agreement prototyped for many of the record keepers. 3 large prominent record keepers have already signed on to this agreement, and it's going to be providing portability between retirement plans. So envision this, envision that you have an employee who leaves the firm and they have, let's say, $4,000 in their 401k that's vested. Right now, again, our team deals with this all the time. You've got to fill out a lot of forms, to get that money moved over from your current provider to your new employer 401k plan. These 3 firms, and I think there'll be a lot more that sign on to this agreement, have basically made a handshake agreement between one another to go ahead and create a very smooth, quick, efficient transfer process so that they'll transfer money between record keepers with just a very simple authorization from the employer side of things. So we've yet to see this actually physically happen, but they're telling us at the national level this is going to come about very, very quickly. And it sure would be a nice, convenient thing for employees. Tammy or Zach, do you want to add anything about that you might have learned from the conference?
I think my biggest takeaway from the conference with this is that this will prevent all those small IRA rollover balances for the under 5,000, and it'll keep all the money together as people change jobs. So I think it's really exciting.
Yeah, it could definitely make things a lot easier for people. To that end, a little talked about part of the Secure 2.0 Act was also the federal government has now set aside money for the establishment of a federal database. Just yesterday, we were working with participants at one of our retirement plans, and the employee said that, I think I've lost some money. Like I had an employer like more than 10 years ago that I swear that I had money with them, but I don't get anything from that. Right now you go to the Attorney General in the state in which you think you lost that money. This would be establishing a federal database. So I do believe that's something coming down the pipe. There's been a lot of discussion about employer match and the ability to make a student loan repayment in lieu of a matching contribution to a 401k participant. I would tell you right now that the vast majority of record keeper providers are not ready for this provision. It's gonna be slow in coming, but we have a lot of employers at the professional trades, law firms, engineering firms, accounting firms. They're trying to recruit in the medical field. They're trying to recruit employees, and most of those employees are coming in with student loans. I would tell you that this is because this is a very long discussion and it could be extremely beneficial to your organization. This is definitely something you're going to want to engage with us for a private meeting. Send us an email at the end of this presentation if you want to know more about how this might impact you. Some record keepers are going to be prepared soon. Others, I think, are going to never be prepared to implement this. So this may be if this is an important feature for you, it's going to make your record keeping decision probably pretty important. I'm not going to address bullet point 4 here, the pension link emergency savings, because Zach's going to go in kind of a deeper dive on that. But I would transition, and Tammy, let you talk about kind of the audit changes that are going to be happening. This is definitely a benefit. If your plan is subject to an audit or at the risk of being subject to an audit, those rules are changing. And so, Tammy, why don't you drill down a little bit on how that's changing for our clients and companies?
Yeah, absolutely. Thanks, Tim. Well, if any of you know me, managing your audit and keeping an eye on that is a big piece for me. And why all these exciting Secure 2.0 things were coming into play and the rules were getting passed, the government quietly changed the requirements around benefit plan audits. So it occurred and it didn't really get a lot of fanfare because Secure 2.0 kind of overshadowed it. So we definitely wanted to give it a little bit of a spotlight because it does impact quite a few plans. So starting with the 2023 plan year, so the year that we just finished up, that all the record keepers are doing the year-end compliance work and the Form 5500s for 2023 is going on right now. They changed how you count eligible participants in your plan. Prior to 2023, it was anyone that you had on your payroll that was eligible to participate, whether or not they chose to, terminated participants with an account balance, active employees, brand new employees on the first day of the plan year, kind of confusing. And if you didn't have high participation, that could easily trigger an audit. But they changed that. So starting in 2023, it's just very simple. Anyone with an account balance on the first day of the plan year, both active or terminated, is your number. If that number is over 100 employees, then you need a benefit plan audit. If it's under 100 employees, you don't need a benefit plan audit. And then there's a little bit of gray in there for the 80 to 120 rules, what we call it. But if you fall below 100, no audit, and then you creep up, but you have 110 employees with account balances, you have some grace, so you don't need an audit until you hit 121. And that's where the provision that Tim just talked about for the cash out limit going from 5,000 to 7,000 is really going to help with the benefit plan audit scenarios as well, because you're going to get those smaller account balances out of the plan. So for those companies that are kind of on that bubble, you have an audit, but you've got 130 employees that are eligible, you might want to have a conversation with your auditor because you might not need an audit for this 2023 plan year. I've got 4 clients that come right to the top of my head that didn't have to have an audit this year, and it was a pleasant surprise and a nice little savings to their budget. So something to be aware of. We keep an eye on that every year as well, kind of monitoring everything. But if you have any questions, as Tim said, please reach out to us and we can kind of help you walk through that as well. So with that, I will transition us over to Zach so he can talk a little bit about the emergency savings.
Thanks, Tammy. Yeah, we wanted to pull these emergency savings out and talk about them because I think it's really important that they added these provisions. And as we kind of discussed already, they added 2 different levels to these provisions. One of them is what's already available now, as kind of Tim ran over. That was one of the bottom bullet points, and that's that $1,000 distribution that you can take. You can do that again, just to repeat, Tim, one time, and then you have the option to repay that $1,000 repayment within a 3-year period. So if you repay that within the 3-year period, it restarts that clock on when you can take a new $1,000 distribution. But if you don't happen to repay that within the 3 years, essentially, at the end of that 3rd year, your clock restarts. You get another $1,000 distribution. Again, the penalty for taking that is waived there. And if you've been saving in like a pre-tax method, then you would pay the tax, that you would owe. And if you've been saving, Roth, that money would come out tax-free. But again, it's a little nugget to give employees to add to the plan now to kind of help clean up with maybe some of those hardship and loans where it's just the amount is small, but an employee just hasn't quite saved enough, maybe in their emergency savings account, on their own or something like that. Now, shifting kind of to that second phase, or something that maybe is a little bit more to bite off, is the pension-linked emergency savings account. I kind of call it the emergency savings sidecar. So essentially what this looks like, it's a bucket of money that would sit right alongside an employee's 401k balance. It would be separated because this employee has 4 withdrawals a year to get at this money. And so what that would look like is an employee who is maybe currently saving, or a new employee who comes on to a plan, their first contributions go into filling this bucket of $2,500. That's what'll sit in this kind of sidecar emergency bucket. And they can take up to 4 withdrawals out of that per year. If they take a withdrawal out of that bucket, so let's say I have $2,500 in there and I take $1,000 out, my next contributions to the 401k will always go back into that bucket, so that way that $2,500 is full. If I reach that $2,500 bucket and I don't need it for an emergency right now, and I want to continue saving in my 401k, just all my new contributions continue to go into my 401k like they normally would. I get to choose pre-tax or Roth and invest them. But the money that stays in that $2,500, it's going to be in kind of like an interest-bearing account. So it's going to be generally sitting there. It's not going to be subject to all the other investments like you have, in your 401k. And again, it can be accessed. That's something that, as we probably see it now, that you'd contact through the record keeper and be able to take a distribution for. This is still, like Tim mentioned earlier, with the student loan matching, this is going to kind of fall in that bucket that some record keepers are gearing up to make this a plan provision that will be available, and some, this is going to be pretty complicated, and so some, might never get there. If this is something that you feel would be a really good tool for your employees, kind of shoot us a message, and we'd be glad to go into more depth with you. But I'm really excited about this. I think something like this and the $1,000 withdrawals, emergency savings, and kind of building the building blocks for employees on what they should do first, whether it's get an emergency savings, then start saving in the 401k, and so on. I think this is going to be a tremendous tool and really solve a lot of problems for a lot of people.
Yeah, I think it's going to be one of those love it or hate it provisions. Some companies are going to see it as, taking away from the message that the retirement plan is designed to be retirement and retirement only. And then other employers are going to realize the fundamental necessity of their workforce and the need to be better prepared. And so again, it's okay. Your attitude towards this is probably completely right? But it's just a matter of understanding how it works and making that affirmative decision.
Yeah, I totally agree. So kind of looking forward then, a couple things. We've kind of covered what's been able to be added to a plan here in 2024, but looking forward to 2025, I hope most people are familiar with the catch-up contribution that at age 50, you can this year add another $7,500 to the normal IRS limits for saving in a 401k. At age 60, so if you fall between 60 and 63, you're actually going to be able to contribute a little bit more. And so that's going to be a greater of $10,000 or about 150% of whatever that regular, just regular over age 50 catch-up contribution is. So again, we're realizing the need that, if we have the ability to save more as we kind of get into those final couple of years of retirement, let's get people saving a little bit more and kind of getting to some of those last minute goals. And then we started to talk about some of the things that are now been pushed back to 2026, and that's the catch-up contribution, like I just talked about, being actually a Roth contribution. As it sits now, those employees are putting that catch-up contribution in a pre-tax form, but we're really in 2026, it's going to be mandatory that those be Roth contributions if you make greater than $145,000 in a calendar year. So that was something that they had kind of on the 2024 docket, but it was pretty fuzzy as to how that was going to work. And we heard, Tammy and Tim, you guys know this, we heard from a lot of record keepers that this was going to be a massive undertaking, and the headache that, is it someone who earned $145,000 last year, or is it someone who's expected to earn $145,000, in this year? What if someone bonuses at the end because of a profit sharing or something like that? They've been making pre-tax catch-up contributions throughout the year, and now they've just barely crested this 145 by the end of the year. Do we have to redo all their contributions? So all of those questions, we're going to be kind of sorting out over the next year or so. And again, by 2026, we'll have some more clarity on that. So you might have heard us talking about that, but just know that was pushed out a little bit later. And again, Tim mentioned earlier that there's a database being created to kind of help employees find maybe missing accounts. I think, one way to easily do that too is to start sending a paper statement at least once a year. I get a lot of questions from employees. They say, I know that money was at that old employer, but if I just had a statement, I'd know who to call, but I can't remember who it was, and I signed up for everything electronic, and my email may be changed, so on and so forth. Getting a paper statement hopefully will help to kind of relieve some of those missing accounts, and then even further a database down the road. We'll be able to keep that a lot cleaner for more people. So those are the things to come here in the future. Tim, Tammy, if you guys want to chime in on and add some color to any of those?
You covered everything I would have said, so good job.
Perfect.
Makes me want to buy stock in a paper company again. Yeah, maybe come 2025.
Let us know how that goes.
Okay.
All right. Now, new plans. Again, another industry trend that we've seen is that a lot of people want to save. We know a lot of people need to save. When we go into a 401k, if there's not someone saving in a 401k plan, it's probably because something else, is going on, whether they have maybe some credit card debt or some student loan debt. Again, that's why that matching program is going to be great. But we know a lot of people should be saving, and they can. We just need to facilitate them, to do so. And so over the last 5 to 10 years, having an automatic enrollment has been optional to add onto your plan. And I would probably say that most people who have adopted that automatic enrollment have seen an increase in their participation, and they've really, they've had a good result, of adding that. Now, to play devil's advocate, there's going to be plenty of people out there that's saying this is now going to be a major headache if I want to start a 401k plan and I have to auto enroll every single person in the company, knowing that, some of them, don't want to do that. But again, I think over time, the benefit of getting people in, and even if it's at, just 3%, the minimum to start an auto enroll is 3%. You can go up to about 10%. That 3% is going to go a long way. And I think just behavioral finance tells us that, if you get someone in there and you get them saving the 3%, if you just make them do it versus letting them do it, you're going to get a lot more participation, and you really will probably hear less grumbles than you think. But I think this is going to be a great way to get people saving and to do it and to have broader participation. So you have the choice then at that point, whether to start at 3, to start at 10. There's going to be an auto increase that's also attached to that. And again, you can choose when that caps out at about 10 to 15%. The default investment choices on all those things are going to stay the same, as your normal 401k. Now, they did realize that, this just isn't going to work for everyone. So if you're a new business, like you've just started the business and you're within those first 3 years, they're not going to require you to do an auto enrollment. If you have less than 11 people in your company, they're not going to require that. And again, if you've done if you're just a simple 401k or a governmental church plan, there are some exceptions to that. So if you're watching our broadcast today and you're considering starting a new 401k, know that you'll probably be in that camp of having to do an automatic enrollment, but just know there are some exceptions there. So.
And then I think worth mentioning, since I did just talk so much about the potential for benefit plan audits, that last bullet, number 3 on the screen there, that allows permissible withdrawals. What that means is if you get someone that's automatically enrolled in the plan and they come to you and they're like, I do not want to be enrolled in my plan, I don't want this, you have 90 days to refund their account so you don't have a small account balance hanging out there. So I think that's a good feature as well.
Yeah, we all know we all know that you're gonna tell, till you're blue in the face to say, hey, if you don't want to be in, they're gonna make it really easy to get out, right? And that's what our job as the advisor is. If there's an automatic enrollment plan coming, we're making it very clear. Hey, here's the paper form. Come sit down with me if you don't want to enroll. Tell your HR, they'll tell us. No matter how much you do that, there's going to be a couple people that kind of fall through the cracks. So instead of someone just contributing for 1 or 2 paychecks and then finally figuring that out, and now they have this really small balance just floating out there. Yeah, thanks for catching that, Tammy. You'll have 90 days to kind of clean that up and get that money back to the employee. So now, Tammy, why don't you take us over to the corrections and talk a little bit more about that?
Yeah, absolutely. Thanks, Zach. So we all know mistakes happen. We can try our very, very best to get everything done and get our I's dotted and our T's crossed, but every once in a while, someone that should be automatically enrolled is just going to slip through the cracks and they're not going to get enrolled. And we got some more definition with Secure 2.0 on how to make these corrections when those errors happen. And this doesn't just apply to new plans. This applies to any plan out there. So we were happy to have some additional guidance. So this is really high level. So if you do run across an error, reach out to us and we can help coordinate with the record keeper on how to make sure everything gets corrected appropriately. But kind of the general guidelines is the correction window to correct when you realize that you didn't get someone enrolled in the plan is the earlier of 9.5 months following the end of the plan year in which the failure occurred, or the last day of the month following the day when the employee came to you and said, hey, my salary deferrals never started coming out of my paycheck. So if you get that verbal, get them in your retirement plan right away and get those salary deferral deductions started, because that kind of starts your correction window. And if you do that, in the past, you had to make up the missed deferral opportunity. So they would make you go back and look at your discrimination testing for the last year and calculate how long the employee was held out of the plan, what they probably would have deferred, and then the employer had to fund that in what they called a qualified non-elective contribution. But with the new guidance we received, as long as you satisfy the 9.5 months or at the last day of the month following, you get notified that they need to have those deductions started, and you provide a 45-day participant notice, which every record keeper has an easy template that you can use to satisfy that, then the employer doesn't have to make up that missed deferral opportunity. So that's great news. However, if your plan does have a matching contribution, then you do have to go back and calculate the missed match that they would have received, as well as any earnings. And they said to get that corrected is the deadline is a reasonable time after the corrected deferral begins. And typically they just kind of leave it out there as this vague reasonable. Well, what is reasonable to me might not be reasonable to you. So they clarified that as well. And they said, for us, reasonable means 6 months after that first deferral got started. So we're real happy to have some guidelines on how to correct, because we all know mistakes happen and that's just the way it is. So now that we've got the guidance to get everything corrected. So don't be afraid of automatic enrollment. It's not as scary as you think it might be. So with that, I will bring Tim back into the conversation to talk about employer Roth contributions.
You bet. It's this is probably 30% of the conversations that we're having when we're out in the field working with your participants and even with your committees. Roth is a huge and important subject going forward. And these are going to be some changes that I think are going to really have an impact. The ability under, again, we're reading here bullet point 1, Secure Act Section 604, it added the ability for participants to elect and have their matching contribution or the company's non-elective. For example, maybe you're doing a 3% non-elective contribution. You're having that ability to have the employee designate that as Roth. So here's a circumstance, and we come across this all the time. We were working with participants yesterday, about 5 of them. We walked them through the scenario, and it was absolutely the best thing for them to defer out of their paycheck Roth. We've had that ability. That's not new. But we also then have to tell them, yes, but your company contribution, your organization's contribution is going to be pre-tax no matter what. That is all changing. We're actually starting to see record keepers ready and able to let you change your organization's match formula to a Roth contribution so that is seamless for the employees. So they're building up 100% potentially of their retirement benefits in a Roth tax circumstance. So I think employees are going to really benefit from this. I don't think it's going to be something that's going to be terribly difficult for you to implement at your organization on this provision. I mean, it means a little bit of a change. Nobody likes change, so probably nobody likes Secure Act 2.0. But I think this is just going to make plans better over time. Again, there's several bullet points here that give you kind of the dirty details in terms of how that's going to look. The election needs to be made no later than the time the contribution is allocated. In other words, we can't go back and change previous allocations, but it's always going to be on a go forward basis to give that employee that ability. And then they need to make sure that they have at least a kind of I call it a re-enrollment. Just like you do now, you have to have a notice that will be sent out, most likely by the record keeper, saying, hey, at least once a year, affirm that decision to make sure that pre-tax or Roth is the type of choice you want to make. And again, it's not a requirement. This is not going to be a requirement that everybody has to be in Roth or that everybody has to choose Roth. It's simply, and some people are calling it dynamic matching, so that some employees who want pre-tax get pre-tax. Some employees who want Roth get Roth, hence the term, dynamic. I think that's all. Yeah, unless you want to add some color there.
I always have to add color. Isn't that what I do? As Tim mentioned, we were just at that national conference last week for all the retirement plan advisors. And the nuggets I picked up on from this is that right now, all the employers are super excited about this, but there's only 2 record keepers that can actually do the Roth employer contributions right now, because there's a lot of behind the scenes programming that needs to be done, and there's still some clarification needed. What they were hinting at is that if they elect to do the Roth as an employer contribution, the company obviously still gets the deduction on their taxes, and probably the record keeper will send a 1099 to those employees so they can report it as income on their taxes, so they can pay the necessary taxes. And they said probably you would only want to do it for employees that are 100% vested, because you don't want to have the employees pay on something that they may not get down the road. So if they pay taxes on it, they should have 100% ownership in that piece of it. But those were some of the nuggets that I gleaned. So.
Yep, it's never quite as easy as it might seem.
Right.
You know, there's certainly some thought and analysis that needs to go into that. With that in mind, I would probably wrap up today and just say that, you know, thank you for being attentive to this. We wanted to bring some of the most important provisions, you know, in place right now. There's some, I didn't mean to skip over those deadlines, Tammy. I mean, there are some deadlines. We can quickly highlight those. You know, you need to implement some of these provisions. If you're a client of our firm, we're obviously making you aware of all those deadlines. Again, there's not a deadline to anything that's not available at your record keeper, but, you know, more along the lines of some of the mandatory deadlines. So, you know, reach out to us if you have concerns or questions about that.
And we're seeing it work with the record keepers is, although the formal plan amendments don't have to be in place and signed until December 31st of 2026. They have created the intent to amend, so they have you elect which of the Secure 2.0 provisions you would like to have added to your plan. And then from now through the end of 2026, your plan will operate as if it has been amended. And let me tell you, some of those checklists and intent to amend forms that the record keepers have created are pretty confusing. So definitely please loop us in. And we've been helping our clients fill those out so they can make sure to get the right provisions that they want adopted for their employees. So.
You bet.
And then this is just a little bit of a further breakdown. Probably the majority of our clients are going to have that December 31st, 2026 deadline, but there are some special extensions for specific 403B plans and some governmental plans. So just some different ones to be aware of. You
bet. Thanks for that reminder. The Department of Labor spoke at the most recent conference that we were at. It's interesting to take their perspective. The leadership in this country still recognizes that over 50% of Americans do not have a retirement plan available to them through their employer. And so you're going to continue to see enormous amounts of pressure and enormous amounts of what the government considers improvements to try to make retirement plans available to participants. So we're excited about the future. We're excited about, we understand the difference between having a retirement plan and not having a retirement plan in terms of the difference it can make in your ability to save and prepare for your future financially. So it's certainly something we're embracing. The state of California was the first state in America to require that an employer with 2 or more employees have a retirement plan. Since that time, 18 states have followed suits. Another 6 states have mandatory retirements going into place this year. That will put us to nearly half of America requiring some form of retirement plan. And so as that momentum builds, you know, I think what we're going to see is what they're now seeing in California is that because there's a mandate to have a retirement plan, those retirement plans are not choosing a government option. They're actually going to a private provider. You know, the Fidelities, the Vanguards, the Empowers, K-Trade, Alaris, those providers in the country are going to see dramatic increases in the number of 401ks and 403bs that are being opened. As always, we're here to help you. We're gonna turn and record a shortened version of this. Just as a reminder, if you came in late, we will be sending you a copy of this presentation that was recorded. We're also going to be sending you a very short version of this that you can perhaps use with your committee. We're also going to be documenting for every person on the call today. If you are a plan sponsor, if you are a committee member and acting in a fiduciary position, we're going to be documenting that this certifies some of your fiduciary training, which is really, really important in the event that you're ever questioned about what types of training you go to. So thank you for training with us today. And Zach, Tammy, thanks for your participation and for our team behind the scenes running the presentation. I'm going to leave another minute or two here for questions. You're welcome to drop off if you're completed, but just simply raise your hand and we'll be glad to answer any questions. Go ahead.
Darren, you should have the option to unmute now.
Okay.
There we go. Yes, I just had a question on the emergency expenses for the $1,000 distribution.
Mm-hmm.
What constitutes an emergency for that type of distribution? Is that subject to the hardship rules or anything like that?
Zach,
yeah, the $1,000, there's not going to be a definition that's tied to that, because this is this is going to be one of the options that gets out of those definitions, adding flexibility to the plan. So
it's basically self-attested. If the employee feels like it's an emergency, if they're out of diapers, well, that's an emergency.
Got it. All right. Thank you.
Yeah, and I guess just to go back to that point, Tim, on your slide earlier when you were going over some of those, all of the QBAD, birth and adoption, the FEMA disasters, this $1,000 withdrawal, those are all self-certifying. The only one that is not, I believe, is the terminal illness. So as a plan sponsor, you get to kind of take a step back to being the approval, of someone proving one of those hardships. And so again, you're kind of leaving that for the employee to contact the record keeper and talk through that. Thanks for your question, Darren.
And when we say self-certification, what that means is the employee would need to document their file when they file their taxes at the end of the year. And then should they ever get lucky enough to get audited by the IRS, then it's up to them to produce the documentation to the IRS that, yes, indeed, I did have an emergency.
Yeah. Not likely, but.
Yeah. And that goes not only for the $1,000 distribution, that also would go for the same if your plan in the future adopts that emergency sidecar, the pension link savings. Again, those are going to both be options that is going to be money available, not subject to a specific definition that an employee can get to.
Any other questions? Just simply use the raised hand feature. All right, everyone. Thank you for joining us today. Again, we'll send out copies of the presentation, and thank you for participating today.
Thank you.